Good afternoon. I'm Dana Eubanks, and welcome to the Chicago Treasurer's Office Money Matters Institute, an exciting new financial education and empowerment program that the Treasurer's Office is offering. Money Matters Institute is also known as MMI. The mission of MMI is to empower all Chicagoans with the knowledge and skills needed to make informed financial decisions to build wealth today for tomorrow. MMI is a 3-session series of programs through webinars and workshops. We also offer one-on-one personal financial counseling now through November. In today's session, we're going to be presenting Investing for Beginners. The workshop will help you gain knowledge that you need to know to make informed decisions and enhance your skills on various topics around investing, how to get started, how to make it work for you. Throughout the presentation, please feel free to post your questions in the chat. At the end of the presentation, we will respond to your questions. We are honored to have our educational partner with us today, Robert Majecki. He is the Senior Vice President and Chief Investment Officer at Amalgamated Bank of Chicago. You also see your logo there, ABOC. Amalgamated Bank of Chicago is here to help us learn how to begin investing. So Robert, thank you so much for joining us this afternoon. We're very grateful to you for sharing your expertise.
Thank you, Dana. I appreciate the opportunity, and good afternoon to everyone. And thank you for joining us today. Before we put the first kind of slide up, I just want to talk about basically getting started with investing. Before we discuss investing alternatives or different types of investments, I want to start with something that's quite basic, yet important. What do we mean when we say investing? And what I mean by that is simply stated, investing means putting away money for future use. That could be in the stock market, the bond market, checking accounts, savings accounts. There's a whole litany of different types of instruments, and we'll go over them kind of in a definition one by one to try and give you some information that you can start with, or maybe to help you if you've already started. So with that, I'd like to say is you can choose. When we're looking at investing, you can choose from thousands of stocks, bonds, mutual funds, other investments. That includes checking accounts, IRA funds, and things like that. And unfortunately for the beginner, and even for most experts, I'm not sure I consider myself an expert, who are honest with you, knowing the name of the type of investment is just a tip of the iceberg on what is out there in investing. There are books and books and books that will tell you different things. Underneath each of these investments is a mountain of details. Now, with that saying, making wise investment decisions doesn't need to take a lot of your time. If you know where to get good quality information and you purchase well-managed investments, you can leave the investment management to the experts. That means you can go into like a fund or something, let people do it for you. Then you can do the work that you're best at, which is free times for fun stuff. What we want to look at is for investing for the future. You want to put away money to be able to do something in the future with it. An important part of making a wise investment is knowing when you have enough information to do things well on your own and when you should hire others. That's a time, I don't know that you want to hire somebody when you have $500, but once you start to build up a nest egg, that's when you may want to look to have somebody help you. For example, investing in foreign stock markets is something individuals generally probably shouldn't do. They should hire an expert that has really good research and understands those markets compared to domestic markets, meaning markets that are in the US. So hiring a good money manager at that point in time with using a mutual fund makes more sense when investing. And hopefully I can give you some of the information that you need to help understand the markets and will allow you to make your way through this complex investment world. This is something that, it could take hours and hours to explain various markets to you. We won't go through a lot or go very deep in this time period. What we will do is cover what are the basic instruments in the investment world, how they work, and how the markets work. Hopefully this will leave you with a better understanding of investments in general. And if you could move to the first slide, it's basically kind of what we want to talk about. What is an investment? And here I'll read it, but an investment is an asset or item acquired to generate income or gain appreciation. And again, appreciation is the increase in the value of an asset over time. And it requires you to put money out today so that you can have a higher return on something in the future. That investment can be a stock, a bond. It can be art. It could be real estate. It could be a car. It could be baseball cards. It could be precious gems. It could be a lot of different things, but it's that outsource of money at the beginning, but you have to do your research and looking at what you want to do for each thing. What we're going to do from here is go through kind of a list of different investments that you may know what they are, and maybe you don't, or you've heard about them. With that, we'll go to the next slide and just start out with kind of, everybody thinks of the markets as the stock market. And what are the markets doing? We hear that the Dow is up so many points today, or it's down so many points today. What is a stock? And a stock is also known as an equity. And what people don't realize that security, or you buy a stock, and I'm just going to use a name. If you buy stock in Coca-Cola, that represents an ownership of a fraction of the corporation. That means you now are this percentage of an owner. The unit of stock are called shares, and it entitles the owner to a proportion of the corporation's assets and profits equal to how much they own. It also can, depending on the stock, also qualify you to get a dividend when and if the company pays a dividend. Stocks and bonds, bonds too, but stocks are bought and sold predominantly on a couple different stock exchanges, and they are the foundation of many individual investors' portfolios. As we go along, and you can buy individual stocks, you can buy portfolios of stocks. So the stock trades have to conform to government regulations, and those regulations are meant to protect investors from fraudulent practices. If we go to the next slide, now what I'm doing is going over different types of securities that could be a portion of your portfolio, and each has its own risks, each has its own payouts. What is a bond? Many people don't know what the bond market is. And as I mentioned in a stock, when you buy a stock, you're buying an ownership of a corporation. A bond is a fixed income instrument, which is basically you are now loaning money to a corporation, or many times you're buying a U.S. Treasury note or the government. And it's bought at an interest rate for a certain amount of time. The entity repays the individuals with interest over time, usually at a 6-month period of time. And at the end of the bond maturity, which you call it a maturity date, you will get the face value of that bond. So if you bought a bond for $1,000 for 5 years at 5%, you would be getting a 5% interest payment every year. And at the end of that time period, you would get your $1,000 back, plus you would have earned the 5% on that bond over that time period. Now, bonds are used by companies, municipalities, states, sovereign governments, including us, to finance projects and operations, or to finance how we finance our government. Owners of bonds, as I mentioned, are debt holders or creditors of the issuer, meaning that you are loaning money, they now owe you that principal back. Bond details include the end date, which is a maturity date like I talked about, when the principal of the loan is due to be paid to a bond owner, usually include terms, and they're variable or fixed interest payments. And as I mentioned before, it is a loan to a company, almost like you are when you do a mortgage on a house. Basically, you have to repay that. That's what the bond company is doing for you. They're repaying that loan over time, and at the end of that time, they will be paid in full. With that, we'll go to a few other types of instruments that you can utilize. These are specific, a stock and a bond. If you go to the next slide, we'll go to kind of a way that you can broaden your investments, but also take a little bit less risk than buying one particular stock in a company or loaning some money to a bond individual corporation. It's a mutual fund. And many of you know what a mutual fund is, but basically a mutual fund are pooled investments of a lot of people, including yourself or me or anybody who wants to buy into this mutual fund that is managed by a professional money manager. These trade on exchanges and provide investors with access, as I mentioned, to a wide mix of assets selected for the fund. Now, a mutual fund could be a bond mutual fund, it could be a stock mutual fund. So if it was a stock mutual fund, this would be a selection of maybe 500 different stocks. If it was a bond mutual fund, it could be a selection of 1,000 different bonds. So what they're doing within these funds is diversifying the asset mix so as the risk will be a little bit less for everyone that buys this. Professional fund manager handles this mix, and the fund's assets and goals are detailed in the prospectus. And if you want to take a look at that, the prospectus is usually, unfortunately, about 120 pages long, and it's a lot of legalese, but it's there for the protection of the investor that's going in. For those who deposit their money into the mutual funds from their paychecks, they offer automatic investing, lower investment risk than buying individual stocks on your own, because these funds, as I mentioned earlier, have diverse holdings. So they're trying to basically protect everyone from the risk of buying an individual stock or a bond. We'll go to the next selection of it. The thing we're looking at, this is a little harder to understand. It's what they call ETFs, and people have heard about this. An ETF is just an exchange traded fund or exchange traded mutual fund. They've created this security so you could buy an actual stock in the fund. ETFs can be structured to track anything from a price of a commodity to a large diverse collection of securities. So these ETFs follow what the mutual fund usually does, but they trade on a daily basis, and they trade individually daily, as opposed to a mutual fund that has an end price at the end of every day. That's when they settle on the price of the mutual fund. You see the second sentence there, ETFs can be designed to track specific investment strategies. They can be for bonds, they can be for stocks, they can track a foreign exchange, they can do a number of different things. And they can also track certain indexes. So these indexes are out there as what we call a benchmark of securities so that these funds can follow that. If you turn to the next page, we'll talk about a few other things, and then we'll talk about the markets. We also have what's called a municipal bond. And it's the same thing as a normal bond, except it's a term that we use, a debt securities issued by local, county, state governments. Again, the city of Chicago has municipal bonds. The state issues municipal bonds. They're, again, commonly offered to pay for capital expenditures or doing something for the city, the state, constructions, highways, bridges, schools. They're issued in debt, but they are also tax exempt. And that's a good thing for us who don't want to pay taxes on them. As you see, their municipal bonds act like loans, just like a bond does, in exchange for borrowed capital. Bondholders and investors are promised interest, the same usual way, payable yearly, or they usually pay in 6 months, and then they repay the principal on the maturity date. Municipal bonds are often, and I shouldn't say, I mentioned before, they're exempt from taxes. They're often exempt from most state taxes, which makes them attractive to people in the higher income brackets. And I brought this up just for something just to look at, because it's another part of the investment litany of investment items that you can use when you're looking at investing for a portfolio. With that, we'll go to a certificate of deposit. And a lot of us buy those. Every bank, well, I shouldn't say every bank, but most banks issue certificates of deposit. And that's basically, it's almost like a bond, it's a loan. It's a type of savings account that pays a fixed interest rate for money held for an agreed upon period of time. CD rates are usually higher than savings accounts. That's because you're allowing the bank to hold on to that money for a specified period of time, because you have to wait until maturity to withdraw that money, unlike a savings account or a checking account. If you withdraw a CD early, you'd usually be charged a penalty, and that penalty usually means that you're losing the interest that you've probably earned up until that time. So if you had a 1-year certificate of deposit and you needed to get out of that CD 6 months in, you will not get the interest on the back 6 months. You will only get part of the interest that you earned. CDs come in a variety of terms, just like bonds do. They come in terms of 3 months, 6 months, 12 months, and it could be 1, 2, 3, 4, and even 5-year, 10-year terms. So with a CD, you're going to the bank. You got to remember that when you buy a CD, you're protected by the FDIC insurance of up to $249,999. So if you do want to purchase a CD with any bank, whoever it would be, you want to make sure that you stay under that. Most of us would be buying a CD for maybe $10,000 or $25,000. We're well within the FDIC insurance. And if there was a problem with a bank, you are guaranteed to get that principal back plus interest on a certificate of deposit. We'll go to the next page and we'll talk about what is a lot of us have an IRA account, and it's an individual retirement account, and it's a long-term tax advantage savings account that individuals with earned income can use to save for the future. You do not pay taxes on this money until you take money out. An IRA is designed primarily for self-employed people who do not have access to workplace retirement accounts, such as 401k accounts and or a profit sharing plan that a company may have, or various 403c plans, things like that, that cities, municipalities tend to have. Although city and state usually has a pension fund, we won't go into that today, but the 401k is a form of an IRA, but the IRA is something that individuals can use by themselves. You can open it up pretty easily. Some banks issue them. We do not have an IRA that we utilize, but you can go to a mutual fund company and they can open those up. You can go to somebody such as a Schwab or Fidelity or Vanguard. Those are names that I'm using that are pretty generic names. You can open these up for free. Basically, you have to put money into it, but they manage them for free and it doesn't cost you anything. So something that is an alternative to doing an investment, but that's also for the long term, because basically if you put money into this IRA, you're not going to take this out until late in retirement because you're earning money at a tax-free way to go. You won't pay taxes on any income until you take the money out. And now I'm going to go with one last thing, which is the next page, please, is a money market fund. A money market fund, and this is a very safe individual type of mutual fund that invests in short-term securities. Money market fund is a mutual fund, as I mentioned, that is highly liquid. You can generally get your money out of it in one day. And these are short-term instruments that are usually 1 year and under within these particular money market funds. The instruments that are utilized in the money market fund can be cash equivalent securities. Could be commercial paper to base U.S. Treasury bills. They can be using CDs. These are high credit rating, debt-based, meaning almost like a bond with a short-term maturity structure, meaning that it's going to mature in 1 year. You have access to the money market fund at any time, just like your savings account, but generally you are going to get market rates that are intended to offer investors that high liquidity with low risk to put those funds to work at something better than a savings account. And I shouldn't say that because many banks are offering high interest rate savings accounts, but they are tied to what the bank wants to give you as a rate, not basically what the market is giving you. Now, while they sound familiar in name, a money market fund is not the same as a money market account. A money market fund is an investment that's sponsored by an investment fund company. Therefore, it carries no guarantees of principal. Generally, you will get your money back because it's such a short period of time, but it is subject to something that can happen in the market. A money market account is a type of interest earning savings account, so to speak, even though a savings account do earn interest. But again, these are very short term and you can have your money out pretty quickly. And if you went through a mutual fund company which offers money market funds, Many times you can have that money same day. So they can be utilized with checking accounts and tied into various things. They are insured by the Federal Deposit Insurance Corp, and they typically have limited transaction privileges, meaning you can only maybe take so many transactions a month or put so much money in a month. With that, I'm going to stop for a second and basically go into what the markets are. So those are a list of securities or types of securities that you can utilize as your investment base. What we want to go into are two different things, and that is basically, what is the stock market? Because we all hear about that. We hear about that daily. It's one of the things you hear on the radio, you hear it on TV, that the Dow is up 600 points or down 500 points. And we'll talk about when you're going to go into the stock market. The stock market as a whole is an exchange mechanism that helps investors buy and sell shares of publicly traded companies. So you can buy through New York Stock Exchange and offices, they call it the NASDAQ. These are components of a broader marketplace. Now, these trades, you can't go directly to the exchange. You have to go through what we call a broker-dealer, or you can do it within if you belong to a mutual fund company, many times they can trade there. So basically, you can't do it yourself. You could go if you belong to a Ameritrade or you belong on various different platforms, you can buy stock. But the stock market is an ever-moving market, constantly changing. The markets are up, down. You see that constantly. It changes based on what's happening in the market, what's happening in the world, what's happening within our own country, what can be happening with the Federal Reserve, and changing rates will change what stocks are doing. These are basically stocks that have the corporations that are within these stock exchanges have a constantly moving stock price, so that you can see that when you're looking at the stock market, as I mentioned before, you want to really do some research before you buy an individual stock, which is why I mentioned earlier about mutual funds, because using a mutual fund gets you the broadest diversification and the least amount of risk, but it allows you to participate in the stock market. And that's the easiest way to do it until you start to earn some money that makes some sense. Remember, investing is something you want to do very, I shouldn't say gingerly, but you want to make sure this is money that you're not going to need tomorrow. Usually investing is for the long term, just like your pension plan, if you have one, is something that you don't want to touch because it's there for 20 years from now, not 20 minutes from now. With that, we'll go to the next page, which is the bond market. And the bond market is something that you don't hear that on the radio, you don't hear it on TV, but the bond market consists of that whole debt market we talked about before. It includes U.S. Treasury bills, U.S. Treasury notes and bonds. It includes corporate bonds, and it's what we call the credit market. And it's a collective name given to all trades and issues of debt securities. And what we mean by debt securities is, again, we mentioned earlier, what is a bond? It's a loan to a company or a corporation or an entity such as the City of Chicago, the State of Illinois, or the U.S. governments. As I mentioned in this last line here, governments issue bonds to raise capital to pay debts or fund infrastructure improvements. Publicly traded companies issue bonds to finance business expansion, projects, or maintain ongoing operations. And the bond market in general is where investors go to trade debt securities. Now, it's a little bit different than the stock market because there is no real exchange for the bond market. It is something, if you want to go to buy a bond, you generally have to go to what was called a broker-dealer. Dealers are the ones who buy the bonds for you on a specified market, which is out there. That doesn't mean you can't buy an individual bond yourself. Again, as I mentioned before, if you have a platform such as Ameritrade, or if you belong to Fidelity or Edward Jones or something that you have an account, you can buy individual bonds. You also have, but people don't know it, you also have the ability to buy individual U.S. Treasury securities from the government. So you can do that online through various web bases that you can go to, and you can buy that directly from the government. The only problem with buying these securities from the government is that once you own them, when you buy these treasuries through this particular trade lines, you cannot sell them. You have to hold them until they mature. So it's a little bit different than owning a bond that you can go and call your broker dealer and say, we want to sell something today because I need money. It's usually there that you're holding until the bond matures itself. So those are kind of what is within the bond market, what is in the stock market. And basically what I want to end with before we start some questions, because this is very, very kind of above level, was some tips for people who want to start investing. And this is for various, it could be young people or an older adult, is that first off, start investing as soon as possible or as soon as you can with money that you're not going to need tomorrow. Decide how much of a percentage that you want to invest weekly, monthly, yearly, and open an investment account. An investment account can be opened, as I mentioned earlier, with a mutual fund company. You can go to various platforms, and I use Ameritrade just because I know the name. And you can open these accounts and trade for yourself. There is fees to do this. There are commissions to buy stocks. There are generally commissions or fees involved in buying bonds. And even a mutual fund, depending on what it is, will charge you an expense, and it's usually built into the mutual fund itself. And it's something that you need to look at or ask questions about. Pick an investment strategy, meaning something. Do you want to own stocks? Do you want to own bonds? Do you want to just own a mutual fund? Do you want a broad divestiture, meaning you want to have less risk? So understand what your investment options are and where you want to go and how long you want to be in this investment for, meaning, is this something that you want for retirement? Is this something that you want even for, there's different plans out there to, buy different funds for college education funds. So these are all investments that will give you some interest, that will give you principal improvement, and kind of look out for the future. As I mentioned earlier, many people have 401k plans or their other employment plans, and they're different municipalities. But if you can participate, I advise you to do so. It's the easiest way to get into the market, and it's the easiest way to do it slowly, and you won't even notice it coming out of your paycheck. Consider using, if you're into something like that, consider using what they call a robo-advisor, which will kind of look at your fund. It doesn't usually cost anything if you're in a mutual fund, and it'll help you based on your age. If you're going to be in a certain way, basically, if you're 35, they may want to say you should be heavier in stocks than bonds. And if you're 75, you should be heavier in bonds than stocks, just because it's less risk. Consider investing in target date mutual funds, an index fund, or exchange traded funds, as I talked about before. By target date, it means it's based on your age. So they're looking at where you are in your life stream, meaning if you're at 35, you're at 45 or 55 or 65, you're going to look at different ways because you have different needs at that time. You may start to need money for retirement. You start to need money for when your children are born or when they're going to go to school or to college. So with that, I'm going to stop. I think I've hit my time. They gave me a half hour to speak. And we want to ask if there's any questions out there.
So thank you so much, Robert. That was really very helpful to understand bonds and stocks and mutual funds, that you're in the whole party together. So it's not just you bearing the risk. And then what we should do at what age. We've been trying to fix some technical difficulties, so I should let you know that I think it's just for those of you who are watching. Yes, he's kind of on his side, I know. So I think it's the camera that somehow adjusted and shifted itself to put you on the side. We are aware of it. We're trying to fix it. But we'll have to ask you, Robert, if you can shift your camera a little bit or shift whatever happened.
Actually, I'm not sure. I can't. Well, maybe I could do this.
So there you go. Perfect. Perfect. Thank you. There you go.
Yeah, I'll leave it that way.
Yeah. Well, there you go. Perfect. Thank you so much. Thank you. We were on the ride with you though, so we were there. So as we're talking about, we have Evan Price who's asking, would a mutual fund be a good investment strategy for someone working at a 9 to 5 and just starting out?
Yes, it's a mutual fund just to start. Again, you could call up any mutual fund company, and there are so many. I can't name them all. I use Vanguard or Fidelity because of their kind of names that everybody's heard of. But you could call up Charles Schwab. You can call up anybody, and you can open up a mutual fund, and you can usually start it with a really low amount of money. You don't need all that much. I mean,
We lost him for just a moment. We'll see if we can get him back. But in answer to your question, Evan, Robert was saying you can start with a mutual fund. It's easier, safer because you're in the pool with a lot of people. And that way you don't bear all the risk. As he said, the stock market is a little bit more sensitive. The bond market is more conservative and not as sensitive. You are loaning money with the bond. It is used to do infrastructure for governments like our own, foreign governments as well. You can use a money manager to help you with that. And Robert is back. So thank you very much, Robert. We lost you for a moment. So I was just going over again that a mutual fund is a safe way to put your toe in the water and come into the investment.
Dana, I think I lost you. I can't hear.
Uh-oh. So
I don't know if you can hear me. I can't hear you.
Okay.
So you can hear me?
Yes, I can hear you.
Well, put up another question if there's one out there. I'll be able to answer. I just can't hear.
Okay. I think that is our last question. What I was going to say is, but I'm not sure you can hear me. So to summarize, is a bank a good place to go and start investing?
Thank you for the question. A bank is probably a good place, but it depends on the bank itself. Most banks really want you. I mean, you could purchase a certificate of deposit, but to start investing, a savings account is always something good. Anything that you could put away that starts to earn some interest is always good. If you don't have a savings account, it's something that you should open up. But also, going to a bank, if you don't already have a checking account or a savings account, it's a good way to start credit. So you always want to have that. And it's probably not the best. If our bank is very small and we're downtown, we only have a few offices. But if you walked into a JP Morgan Chase bank, somebody that's got bigger and has offices, I think they would be more than happy to help you. They can direct you to different mutual funds and help you start that investment strategy. A lot of times a mutual fund, if you call them on the phone, might be even better than a bank. They'll be able to answer more questions for you.
So for the people who are saying at the beginning, Benji says, what is the best investment management platform to use for beginners? Vanguard, Fidelity, E-Trade, etc. As you said, you're not recommending a particular firm. These are certain ones you should know.
All of these platforms are fine. They're all geared to, they can be geared to somebody has $1 million or somebody has $1,000. I mean, basically they can help you. They are so loaded with information that all of these different platforms are really, really good for the beginner to go into and just ask questions. I mean, that's basically like anything, as I mentioned, you want to go to somebody you could ask as many questions as you can, but also remember that as a beginning investor, it's not, if you have a savings account that you need and you have $1,000 in it, do not go and invest $950 of it. I'm just using that for an example. You want to be able, this is going to be money that you want to put away for the side. It's not taking money out of your daily living expenses. It's something that's like we talk about a 401k plan or any plan that most of us have. You're using that money that you're not going to use. So you want to put that away. And even if it's $10 a month or $15 a month, that will grow over time. There's a thing that they call it's 7 years. So basically for every 7 years, you will double your money. So if you have $15 in 7 years, that will double. If you have $100, it will double. So every time you add to that, it continues to do that compounding effect. Just like when you buy a CD, a certificate of deposit, it's a compounded interest. Your principal will grow over time, but you want to have this structured. Use this as a constant, meaning when you go to Vanguard or any of the ones that we had listed down there, make sure you're doing it all the time. I mean, obviously, if something happens and you have to buy a car, you're not going to be putting money away. But you want to make sure that your strategy is something that you're going to do for the next, not just for 1 month, but over time.
So we have a question. Are apps like Robinhood and Cash App a good place to use for investing?
I don't know the apps themselves, to be honest with you. I know the broad mutual fund apps are much. I don't like some of the ones that have funky names, but they're not. That doesn't mean they're not bad. They're not good, I should say. There are places out there that are very good. Like I said, Ameritrade is one I know of. Just that you can go on there, you can put money in, and you can trade within there. You just got to always remember you got to be careful of what commissions people are charging you. And even when you buy a mutual fund, what's being charged, that you don't want to be paying too much money for what you're doing.
That's the thing. So what type of beginner investment opportunities does ABOC have?
We have, because we're a small bank, we don't have as much for beginner investments. The three things we're going to have is going to be a checking account that pays interest, a savings account that pays interest, and if you have enough money, although you don't have to have that much, I think you have to have $1,000 to buy a certificate of deposit. We can do that too. We don't have a platform at this time that ties into any of the mutual fund companies or a Ameritrade platform to do that. But again, you could do a lot of research. I think almost all of us have access to, our phones and or the internet. Go in there and ask the question. I mean, because it'll tell you what are the best companies to go into. It'll tell you. I'm using Ameritrade because it starts with an A, but you can go to Vanguard or Fidelity or any of these different firms, and they'll be more than happy to help you with what you need. You can even open checking accounts and savings account with them.
Espinola asks, Ameritrade is now a Charles Schwab company, correct?
Yeah, that is correct. So you could, again, they're both the same type of platform, and you can buy individual stocks within that platform. So you can go in, and if you put some money in, it'll be into a money market fund. And from that fund, you can draw those funds to buy individual stocks or even buy individual mutual funds, which even though Charles Schwab has their own mutual funds, you don't have to buy their mutual funds. Even with Vanguard, you can buy any fund you want that's out there, out in the marketplace to do that.
That's something people need to understand. As you said at the beginning, when you get started, you're like, okay, I'm in a space where I have covered my expenses. So I have that money in my checking account or my savings account. You start by having a checking and savings account, which we've addressed in MMI up until now. Make sure you have a budget, checking, savings, your expenses covered, your emergency fund covered. And once you're in that space, now you're ready to invest, correct?
Again, I can't hear you, so it's kind of so if you can type it, I can read it.
You can read the questions, I understand.
Hopefully, if there's any other questions, feel free to call me, or I'd love to answer some questions. The bank would always like to help anybody if they can. I'll give information wherever I can. It's something, or for that matter, you can use my email. Please, my email is armadecki@aboc.com. And if there's questions, send me an email. I'd be more than happy to answer.
All right. Thank you.
Thank you very much. I'm sorry it went away.
Thank you very much. That is Robert Majecki with ABOC.
Thank you, Dana.
Robert Majecki at ABOC. You can reach out to him directly. You can also reach out to us here at the Chicago Treasurer's Office. Obviously, we'll be happy to help you as well. And join us for MMI, Money Matters Institute. We want to thank you for attending this session. You know how this works if you've been with us for a while. If you're new to us, you should know. We do the same topic on this Thursday. Tuesday is our webinar. Thursday is our in-person workshop. If you'd just like to talk to a human. And considering we had a few technical difficulties today, we invite you to come out and join us. This Thursday on the 29th, we will see you, make sure it's on the 29th, we will see you at 4600 Southwood. The Resurrection Project is joining us. We said this is in 3 components, online as we did today, in person for the workshops we're doing on Thursday at the Resurrection Project, 4600 South Wood Street. Please join us at 6 o'clock through 7:30. They're right there. You'll have investment advice. This time it will be Wintrust that will be there. They will be giving you investment advice one-on-one right there in person. And then we also ask you to understand that we have partners that are working with us. The Urban League, the Resurrection Project are working with us right now for one-on-one personal confidential financial counseling. You can talk to the counselors on Thursday night as well and sign up for counseling. You do that on your own. It's confidential. They can guide you through any of the pieces we talked about in terms of learning what you need to learn financially. Now, we also ask you to tell us what works for you with MMI, Money Matters Institute. There's an evaluation survey coming out. There's a QR code right there we ask you to do. It takes less than 3 minutes to fill out the survey. This will help us better serve you. So we really would appreciate hearing from you on what works for you, what doesn't work for you, what you'd like to see, because we want this to work for you to be financially informed. This is the Treasurer's vision, to make sure Chicagoans are well informed and better able to build generational wealth. We thank you so much for joining us today for the Beginning with Investors Investing for Beginners. We hope you were able to learn a lot. We hope you'll come out to see us on Thursday at 6 p.m., 4600 Southwood. And now, a word from our treasurer. Hope to see you Thursday.
Chicago, it's that time again. I am excited to invite you to the 4th annual Building Wealth Today for Tomorrow Financial Summit. It's the largest financial education program of its kind, sharing financial knowledge on home ownership, small businesses, credit and money management, real estate, and all you need to know on how to build long-term wealth. We have an exciting lineup of workshops, keynote speakers, and networking opportunities for all ages. Now, our past speakers have included Conyears-Ervin Johnson, Damon John, Chicago's own Allison Victoria, and Bill Rancic, John Hope Bryan, and more. So it all happens on Saturday, October 12th, from 10 a.m. until 5 p.m. in person at the UIC Forum, free. Did I mention that all of this is free? So for additional information and to register in advance, please visit ChicagoCityTreasurer.com/BWTT. We look forward to seeing you there.